Now, if we do go into higher inflation, the tendency will be for people to move more into inflation hedges, and gold and silver are the obvious ones. So we will see the asset allocation of typical investors towards gold and silver rising if inflation rises. And if we go into a hyperinflation environment, the exposure to gold and silver that they'll want to own will be very, very high. And equities won't be quite as high. But of course, equities will still be rising as they always do. You know, we've seen the prices of stocks on the Venezuelan stock exchange, the Argentinian stock exchange. They've been some of the best performing stock markets on the planet because the currency has been going down. And as the currency goes down, of course, that's very good for the exporters because their profits look really good.
In the fascinating world of global economics, journalist Clive Thompson illuminates the essential connections between inflation, monetary policy, and precious metals, especially gold and silver. With economic uncertainties on the rise, many investors are wisely turning to tangible assets, which can help preserve wealth and provide stability during turbulent times. In periods of climbing inflation, it's natural for investors to seek out assets with intrinsic value and limited supply. Gold and silver stand out as premier options for hedging against inflation, thanks to their constrained availability and continued demand across various sectors of the economy. These metals offer a compelling alternative to traditional investments like stocks and bonds, which can lose their allure as currency values fluctuate. Thompson shares the historical context of the Bretton Woods Agreement, which initially tied the US dollar to gold at $35 per ounce. This arrangement required countries to maintain currency convertibility at set rates, allowing foreign governments to exchange dollars for gold and creating a stable global monetary system. However, in 1971, President Nixon made a landmark decision to end the dollar's direct convertibility to gold, responding to pressure from countries seeking gold redemptions. This pivotal moment allowed gold prices to soar, reaching an astounding $850 per ounce by 1980, driven by oil crises, hyperinflation, and geopolitical tensions. The years 1974 and 1979 showcased significant fluctuations in gold prices, highlighting the metal's vital role as an economic barometer and a secure store of value during financial uncertainty. Thompson's insights reveal how precious metals are not just investments, but crucial tools for investors looking to navigate the complexities of the monetary landscape with confidence and assurance. Before we dive deeper into this video, please take a moment to subscribe to our channel, hit the bell icon to ensure you never miss any updates, and share this video with your friends, family, or anyone who might find this information helpful.
Another interesting thing we had yesterday, Mario, was the price of gold. It hit an all-time high yesterday. I think it's still at an all-time high in every currency on the planet. You can see that chart in the background on my screen here, but I'll just bring that up for you to share. If you look at that, we've got the gold price in Australian dollars, all-time record, Canadian dollars, all-time record, Singapore dollars, all-time record, Indian rupees, all-time record, Japanese yen, all-time record, dollars, all-time record, euros, record, Swiss francs, amazingly, all-time record, and British pounds, all-time record. And I'm quite sure it's at an all-time record in many other countries in the world. Now, it's not the gold price which is at a record, it's the currencies themselves which are at a record low. Now, if we do go into higher inflation, the tendency will be for people to move more into inflation hedges, and gold and silver are the obvious ones. So we will see the asset allocation of typical investors towards gold and silver rising if inflation rises. And if we go into a hyperinflation environment, the exposure to gold and silver that they'll want to own will be very, very high. And equities won't be quite as high. But of course, equities will still be rising as they always do. You know, we've seen the prices of stocks on the Venezuelan stock exchange, the Argentinian stock exchange. You know, they've been some of the best performing stock markets on the planet because the currency has been going down. And as the currency goes down, of course, that's very good for the exporters because their profits look really good. So basically, money is fixed by reference to a unit weight of gold. That was money. And that was what we had less than 100 years ago. At some point, the connection to precious metals was broken. Under the Bretton Woods Agreement, gold and dollars was still the same thing. So every country on the planet, after the Bretton Woods Agreement of 1944, believed that in all perpetuity, they would be able to change their dollars into gold at the rate of $35. So basically that meant the dollar contained a certain amount of gold, which was worth $35 at the time. Now, in 1971, as various nations like France, UK, Switzerland and others started to ask for their gold back, Nixon broke the tie to the dollar on August the 15th and basically said, you can't have it back because we don't have enough for everybody. What he said was, we're temporarily suspending the convertibility of the dollar into gold. So people could no longer get their gold back, and gold started to free float. And by 1974, Americans were once again allowed to buy gold. And by then, of course, the gold price was in the hundreds of dollars, no longer in the $35 that was the official price up until 1971. Now, since America, Britain, and every European country and all around the world, all these countries now were no longer on the dollar standard. The Bretton Woods Agreement had broken down. America was no longer honoring its debts in gold. So every country said, well, we're not going to have a fixed exchange rate to the dollar either. Why should we? Dollar's not gold. So we'll have a free float. So every country started floating their currencies freely. And little by little, they started to realize that they could expand the money supply with no consequences. Why were there no consequences? Because nobody could demand payment in gold. Yeah. They could only demand payment in
Clive Thompson delivers an insightful look at today's economic landscape, shedding light on the intricate relationship between money supply, government debt, and our investment choices. As the money circulating in our economy rises alongside government debt, the true value of our currency faces some challenges. The growing government debt is a critical issue, as more of a country's resources are directed towards managing this debt, which can impact long-term economic stability and limit how effectively governments can tackle future challenges. In the face of these economic uncertainties, Thompson offers some wise and practical tips for individual investors. If you're not ready to dive into gold or stocks just yet, he recommends thinking ahead and purchasing essential items now. This way, you can lock in lower prices before costs go up. This proactive strategy can serve as an intelligent safeguard against inflation. Embracing these ideas can empower us to navigate the evolving economic landscape confidently and optimistically. Let's get back to the interview.
There's a huge amount more of money in circulation, and there's a huge amount more of government debt, which is the amount of money which is owed by the government to the population, meaning everybody is that much richer in money terms, or in fake money terms, shall we say, than they were. That explains why a house which cost £1,000 in 1951 costs £500,000 today. Yeah. It's not the house which is worth more, it's the money which is worth much, much less. You know, people have been accustomed to fairly modest price increases, and they're quite happy to keep their savings in cash, earning a modest rate of interest because they think they're getting richer, even if the prices of what they have to pay, it buys them less after allowing for the interest, especially after paying tax. But what if we enter a scenario where the trust in the currency is declining, and therefore people are in more of a hurry to start buying things or anything? Now, I've often said on your program, Mario, that if you have too much cash and you're not going to invest it in gold or equities, at least go out and buy the things you'd buy next year, which, for example, your grandchildren's parents, that exercise bike that you've always thought of having, do the home extension, or all those kind of expenditures, because it's going to cost you less today than to do it in a year's time or 2 years' time. But what if those prices are now rising not by 5 or 6% a year, but by 20% a year? Of course, people are going to hurry up. They're going to be in a rush. Yeah. And that means there's a panic starting, and the government will bring in emergency measures to stop people doing that, like wage and price controls. House prices are a different kettle of fish because they are largely driven by the cost of borrowing. And we're seeing the cost of borrowing reach very high levels compared with the last 15, 20, 30 years. In the UK and the USA, now 7% mortgages are not uncommon. That's the highest people have ever seen. What that means is if you own an existing house and you have a fixed rate mortgage of, let's say, 3 or 4%, it's very, very hard to move to a new home and pay 7% on your new mortgage, because typically those mortgages are not transferable by the seller to his new home, and typically the new buyer cannot take advantage of that old interest rate. So if you pay off your mortgage to buy a new home, you're literally moving your 4% or 2% mortgage, whatever you were paying, to a much higher rate, let's call it 7%. And that means that people are not really out there wanting to buy houses at the moment unless they really have a very high salary where they can afford 7%. So house prices probably, even if it's not showing up in the official statistics, are probably worth less than they were a year ago due to that. But in the long run, in a hyperinflationary environment, people don't care. They'll buy houses at any price. And the same thing applies to other tangibles.
Gold remains a unique asset, offering a haven during economic uncertainty and inflation. While it may not provide the same long-term returns as equities, its ability to preserve value during times of crisis makes it an essential part of a diversified investment strategy. With its historic role as a store of value and hedge against currency devaluation, gold remains a reliable asset for investors seeking stability amidst financial volatility. What's your take on the role of gold in today's economy? Let us know your thoughts in the comments below, and we'll see you in the next one. If you find this video insightful, don't forget to like, subscribe, and hit the notification bell for more content. Thanks.